Good day to one and all. This is Dr. Sivaraman of iknowindices.com. So I'll be presenting the once a month twin webinar, Tracking the Forex Market Together. So the basic idea of giving this particular webinar is I will explain how exactly the market has to be tracked using the live market code page and also the session timings. Then try to identify the type of moves they are making in the market during different sessions of the day, which will be able to give us insight what is going to be the next move. Thereby, we will be able to capture the swing trade opportunities. So it is a simple market tracking technique, so in which we use only the live market code page as the tool. Besides, we track the market using the GMT time. So it is 8:01 GMT now. So it is on 12th November. Between 8 and 8:45 GMT, I'll be giving the part 1 and explain to you the concepts by which we will initiate trading. And I'll be giving part 2 between 13 and 13:45 GMT. That is the close of the European session. So early and the late European sessions, I will be giving the webinar part 1 and part 2. So during part 1, I'll try to take the positions and try to close the positions during that of the part 2 in front of you, so that we'll be able to understand whether my concepts really work in the market. So first of all, we need to understand that forecast is a forecast, which has got a lot of limitations. So any human-derived informations or the concepts will have its own limitations. And I'm using the statistically derived algorithm with which I'm able to give the forecast and use it as a guiding factor for the intraday trades. Okay, what the forecast says for today. I've been giving Asian Session Live Market Analysis webinar on Mondays and Thursdays. And on Monday, I gave the forecast for the entire week. And yesterday, you would have seen that Euro and GBP started gaining the levels and started making the slide. And again, now you come across the slide. A quick rise during start, and then slide is happening now. And they are expected to rise. So we are going to do the trading during the European session. So the dip is a buy opportunity because the forecast says that there could be a rise afterwards. So for that, we use initially the forecast. Then we use the market reading technique. What is market reading technique? It is a simple market tracking technique. We note down the initial lows and the highs around 3:30 GMT. So around 3:30 GMT, we will try to note down the initial lows and the highs from that of the live market code page in all the 4 majors and 2 commodity pairs. So that is during that of the early part of Japanese session. Then subsequently, we try to find in 4 majors and 2 commodity pairs whether they have breached the high or breached the initial low on the high, or what sort of moves they have done it in order to identify the type of moves they are initiating. So let me go to that of the initial lows and the highs noted down today. And yesterday I given the webinar. At that time the initial lows and the highs were shown. And today the initial lows and the highs are as follows. 1.3390 was the initial low and 1.3414 is a high. They are not breached it throughout the Japanese session after forming it. And then subsequently they just breached the low. 1.3380 is the new low, and currently it is trading at 1.3383. So when they breach the low and stay below the low for more than 30 minutes, we understand that they wanted to do either intentional downward move or extended downward move for 2 hours, or it can be an intentional move of dropping it for 2 sessions and the start of the 3rd session. So I'll come to the type of moves later on. So here you find that Euro has breached the initial low and staying below the low during the start of the European session. Then in the case of GBP, 1.5965 is the initial low, and they breached and formed 1.5949, which is staying below that. So the dip is happening as expected by the forecast. And in the case of USD-Yen, 99.11 is the initial low. They are not breached it. 99.74 is the high, but 99.60 was the initial high, and the market is staying above that. So they are unlikely to make a drop, and they are expected to extend the gain. And that will become a technical trade. Around that of 99.60-65 level, you can take a buy so that they will be able to gain further levels, and we should be able to close it within the same session. Then in the case of CHF, 91.92 is the low. They are not breached it. 92.11 was the initial high, and 92.11 was the initial high, but they went up to 92.20 and currently holding above that of the initial high. 92.13 and 92.15 are the current bid and the ask. So it is staying above, similar to that of yen. So a technical trade opportunity prevails in the case of USD CHF. Then I'll take the positions and show you how exactly we'll be able to determine the profit in such trades. And in the case of USD CAD, 1.0465 was the initial low and 1.0487 was the initial high. And they went up to 1.0491. They're just a brief upward stop and come to that of 1.0487. And once the ask also comes below that of 1.0487, then what they had done it on the upside is an upward stop and before making a small dip. And then they are expected to gain the levels in the case of Canadian dollar, USD CAD. And Australian dollar, the initial low was 0.9326. And they are not breached it, and they are closely holding close to it. Now they just dipped it by 1 pip, and then 93.90 is the high. They are not breached it. So you find that in the case of euro, it is staying below that of the initial low. In the case of GBP, staying below that of the initial low, and in the case of USDM, above that of the initial high. USD CHF, above that of the initial high. Then in the case of Australian dollar, it has just breached the low and they are just holding around that by 1 pip. So it is 8:07 GMT. We will watch up to 8:30 GMT. And if they are not done a downward stop, then we will try to take a buy near that of the initial low. So I'll come to that understanding of the market types of moves after explaining this. Then once the market is near that of the low, stopped breaching the low for more than 30 minutes, we will try to take a buy. And if the market is near the high and stop breaching the high for 30 minutes, and we'll try to take a sell, then keep 30 pips hedging order to limit the risk. And once the position makes profit, we'll keep stop at entry and then try to maximize the profit by trailing the stop as well as the trailing of the take profit order or the limit order. That way we will be able to maximize the profit. So we will do step by step this. So for that we need to understand the market timing. We are in the European session now. It starts from 8 GMT up to 14 GMT. It is going to prevail as a European session. So now 8 to 9:30 GMT is the early session, 9:30 to 12:30 is the mid session, 12:30 to 14 GMT is the late session. So we are at 8 to 8:45 GMT here in the early session, ideal for taking the positions in the case of majors. And mid sessions are ideal for taking positions in the case of crosses. And again, late session, they handle the majors. So they handle only 2 pairs at a given time. So we need to identify which pair they are trying to handle it. The pair which is making more than 40 pips spread between the high and the low, they are trying to handle them. So here you come across in the case of Australian dollar, it is more than 40. Here it is not 40. Here it is not 40. And here it is around 40. And here it is more than 40. And here it is almost 34 pips. So we identify which pair has made more than 40 pips, then we try to take the position. So these are all the conditions. So we follow the market timing and also we try to find out what move they are doing. So after noting down the initial lows and the high, we also identify the net change. The net change is given in that of the live market quote page here, and it shows that Euro is making 16 pips negative net change when compared to that of yesterday's US session close. So from yesterday's US session close, it has just made a dip of 16 pips. Whereas in the case of USD yen, it has gained about 58 pips from that of yesterday's close. And GBP has just made the drop of 37 pips from that of yesterday's close. And CHF has gained about 15 pips from that of yesterday's close. So you find that numerator currencies wherein in a currency ratio or a pair, the currency appears in the numerator. They are called numerator currencies. Euro, GBP and Australian dollar are numerator currencies. Yen, CHF and Canadian dollar are the denominator currencies because they are in the denominator of the ratio. So here you find that numerator currencies are showing negative net change in the case of majors, and denominator currencies are showing positive net change. So they are making the USD gaining move. In the case of commodity pairs, Canadian dollar is showing positive net change, Australian dollar is showing negative net change. So there again, they are making the USD gaining move. In all, during start of the European session, they are making the USD gaining move. So that is what we identify with the help of the live market quote page and also the net changes. Then we watch whether the market is near the low or high. If it is in the middle level, simply we relax, and now they are closer to low. So we will try to take the positions. Most active currencies will be very quick during the early sessions. So we will come to that after understanding the type of moves they are done. Now, you come across in the market the types of moves which happen on a daily basis. The stop end is the one during start and the close of the sessions. They just go above that of the initial high or go below that of the initial low for about 15 to 25 pips and reverse within 30 minutes and come above that of the initial high. In the case of Euro, they are trying to do that. 8 GMT, they just made a dip and they came down to 33.82 and now they have come to 33.87. Once they go above 33.90 and stay there for 30 minutes, that means it was a brief downward stop and before making an upward move. And a false move is the one, they come up to that of the low, not breach the low, and go up quickly in 30 minutes, they breach the high and stay above. And that is referred as a false move. They pretend as if the market is going to fall and without breaching the low, if they breach the low, what will happen? There will be a lot of limit orders of the short sellers that will get filled. So they don't fill them. They quickly reverse and go above that of the high and hit the stops of the short sellers. And that is referred as a false move. The drop before the big rise is a false move. Normally the false moves, they do it during the gap time and also before the data release. Then if the move is for more than 30 minutes, that means they stay below that of the initial low for more than 30 minutes, from 8 to 8:30, below that of 1.3390, then they are likely to hold below that for 2 hours. There is no hurry in taking the position there. They might stop cutting the low for 30 minutes and still they will try to hold it for another 1 hour, and finally they may just breach it by 1 or 2 pips and then start gaining the level. So that means it is referred as an extended move. So always in the market, they make an extended move and alternate with it of the intentional move. And in between, you come across the other type of moves, namely stop and during start and the close of the session, false move during gap time and before the data release, and also the swings during the mid-session. Without breaching the low and the high, they try to make the swings near that of the low or near that of the low or near that of the high, or sometimes between the low and the high, if the spread is narrow. So intentional move is the one which happens for 2 sessions and the start of the 3rd session. So what they do is they continue to drop, hold below that of the initial low and continue to drop and breach the new low around 2 hours. So once they breach the new low around 2 hours from the start of the downward move, that means it is not an extended move and it is an intentional move. And in the extended move, they form the low and stop cutting the low for about 30 minutes and go above that of the initial low in last 30 minutes and stay there. Whereas if it is an intentional move, they continue to breach every 30 minutes the new low and form the new low every 30 minutes. And then sudden drops they make it during the second session and further drop during the start of the third session and then reverse the market. On Friday, you would have noticed that they had done the intentional move on the downside in the case of Euro and GBP. And so they just taken it up to that of the US session and then subsequently made the upward move. So that is an intentional move. So these are all the type of moves they do it. What they do is after that of the extend intentional move, they always make a small stop and or a false move and then swing for some time, then do the intentional move. So intentional move and the extended move alternate. In between, you come across the other type of moves, namely stop and false move and also swings. And during that of the monthly trend reversals, they make the extended downward stop or extended upward stop, and that will happen for about 150 pips or 200 pips in a matter of about 30 minutes and then quickly reverse. And that is what they had done it on last Thursday during that of the interest rate reduction in the case of Europe. So when ECB reduced the interest rate and they quickly dropped about 200 pips and then recovered to 150 pips negative net change and then continued to gain the level back and to the where they started. That is an extended downward move before making a quick rise. And that normally leads to the shift in trading zone. And this is the way they try to see that none of the long holders hold the positions when they make such a big stop, and normally the traders lose the positions, become afraid and cut the positions, and later on they gain big in the market so that they will get the least selling pressure from that of the long holders. So this is what they try to do it during the month end and the new month beginning time, the extended stop-ins. So you find otherwise on a daily basis, these are all the type of moves, 1, 2, 3, 4, 5, which happens alternatively. So now try to find out what move they have done it. Okay, now it is 8:18 GMT, 15 minutes. They have not cut the new low in the case of Euro. And in the case of GBP, they are cutting the low. And it was 1.5949. They came down to 1.5945 and holding it. And 1.5946, they are keeping a sell order. And just one pip above. So here you come across, they are trying to do the extended move on the downside before making a rise. And slowly they are gaining the levels in the case of yen. Already they have gained it. And CHF also, nominally they are gained. And they are still holding above that of the initial highs. So after reading the type of moves, what we try to use it. So hedging, I'll try to explain it later once I take the positions. So now we will come to the of taking the positions. In the case of Euro, we noticed that they have not breached the low what they have formed. So we will try to keep a buy order, buy limit order. So currently market is around 1.3387. Just 5 pips below, we try to keep a buy limit order. See why we keep it? Because you know that in the live market code page or in the platform, there will be quick swings in the market. And in the swing, if we keep an order about 4-5 pips below that market, if we want to buy, they will try to hit it. So that if it is not hit, then probably you can modify and buy to the market. So this is nothing but a fine tuning of our entry. Just now 33.85, they come to, we just kept 3 pips below. And this will be the buy limit order. So our sales stop or the hedging order will be 30 pips below. So it will be a sell stop. Then in the case of GBP, 1.5944 they have formed, and let us watch for another 10 minutes. If they are not breaching it, we will try to take a buy here. And in the case of USDN, I told you that 99.60 was the low, and they breached the initial high and stayed above that. And currently it is around 99.77. So we will try to keep a buy limit order. $99.67, just about 10 pips below, and let us see whether it is filled or not. Otherwise, we'll dip and try to take it to the market. So this is again a limit order, and our sell stop will be so it will be a sell stop there. So I have just showed with regard to Euro, GBP and Yen because it is the early part of the session, so we will not try to take a position in the case of crosses. During this session, we can always take positions in the process. And now the time is 8:22 GMT, and they stopped cutting the low in the case of GBP also. And so we'll try to keep a buy limit order. Okay. In the case of GBP, 1.5946, we have kept the buy limit order, just 2 pips below, and 1.5916 is the sell stop. So in the three currencies, I just kept the orders and watch for another 10 minutes, and let us see whether they are just filling it up. If they are not filling it up, we will modify and try to take the positions at the market. So we always give respect to that of patience. Why patience? Because the market is known to reward only the patient traders and not the impulsive traders. So even if I feel like buying it at the market, I will always try to keep 5 to 10 pips below that of the market, the buy limit order, and see whether it is getting filled for about 10 to 15 minutes. So that later on, we need not repent. Because invariably, the traders, what they do is they just look at code page as soon as they open the trading platform, they find that euro looks very attractive to make a buy. Then immediately they take a buy. In just about 2-3 minutes, you will find a big drop happening in euro. And then they immediately become panic. So instead of that, we just keep a limit order and watch the currencies and see how they are behaving. So that you wanted to take a position, but you are not committed immediately. You are just calmly wait and see what they are trying to do it. Now, in the case of euro, they have come up to that of the initial low. Still, they have to go above and stay above there for 30 minutes for further upward move. But the forecast says that they are expected to gain the levels. And also we come across in the case of euro, they just made the drop, but subsequently the low what they have formed during the gap time, they are not breached it during the early part of the European session. So it also confirms that they want to gain the levels. And in the case of the denominator currencies, they want to gain it slowly because they are holding above that of the initial high. And so they are not going to let loose, and at least for 2 hours they will gain, and later on only they can reverse it. So this is what we identify with the help of the type of moves what we have learned, and then we try to see what is going to happen to our trade. But still, in order to limit the risk, we are keeping the sell stop. And why we should use the hedging. So these are all the orders I have filled. Meanwhile, I'll explain to you with regard to why we should use the hedging. So when you use the hedging, sell or buy stop or entry stop, sometimes it is called a stop order, in loss-making position. So we use the hedging in loss-making position, and we use the trailing stop in profit-making positions. So this way, when the position becomes adverse, immediately our position gets hedged, and so we will be holding one buy as well as a sell position. But if you keep stop at entry in a profit-making position, if the stop is filled, either we will not incur any loss or we will have a minimal profit. So always we think of the entry 30 minutes from the start of the session. So we are now closer to that, and we have kept the limit order, and let us see whether we are getting a fill. So now it shows that we are unlikely to get a fill there in the case of euro and GBP because it is 8:27 GMT. So after keeping that order, we are able to easily monitor the time. We are not anxious. We calmly handle the situation so that we don't mind modifying the order and take the position of the market, because we get convinced that they just formed a low and they just later on gone above that of the initial low and stay there, so that we can take a buy there around 33.91, 92 level. So thereby we find the chances of our hedge order getting filled is very, very negligible. If we identify and track the type of moves, and in most of the cases, we will not be hedged. And today I am just showing to you a demo of this, and we can just see it by 13 GMT, what happens to the position. Then the exit, if you're taking a buy near that of the low, the exit will be near that of the high, but it will be a trailing limit order. That means we can move the market order away from the market in order to maximize the profit, but in the original position, we will try to keep stop at entry and try to book profit, minimal profit in the event if the trailing stop is hit. So we always see that the stop is placed at entry as quick as early as possible. And one of my most reliable concept is, after taking a position, if the position is not making profit for 2 hours, it is better to close the position and then relook at the market, even though it is not hedged. Then in the event if the position is hedged, so in the orders I kept the hedge order. Suppose euro drops this and also fill this. What we have to do it. This is what most of the people struggle, how to handle the hedging. If the hedging is making loss, after the hedging is being filled, and if it makes loss for 10 to 30 minutes, then we try to close that hedging when it is in loss of 2-3 pips or 5 pips, and keep another hedging order 30 pips away from the market and trail it up to the top of the original hedge level once the market reverses. How we know that? Because if it is hedged and then the market reverses, we understand it is only a stop and or an extended move during which our position got filled and subsequently they are not forming the new low. Then it shows that we are hedged during the stop and or an extended downward move. So we will try to close the hedging with a nominal loss and keep another hedging order and bring the hedging order to the original position. And once the position makes profit, keep stop at entry. So that if the market goes against, we are not worried. And we are ascertained or we are very confident that we are only taking at a given time 30 pips risk in the market. Not unlimited risk, not depending upon the market move, we keep 70 pips stop or 140 pips stop or keep 70 pips stop and 210 pips take profit order and say that risk reward ratio is 2 is to 3 is to 1 and things like that. We always limit our risk because our equity cannot withstand more than 30 pips loss. Still, we don't use that stop. Instead, we use the hedging. Why? Because if it is hedged, we try to keep stop at entry and close it. Or we cut it with a nominal loss and keep another hedging order and keep going with it of the original position and try to maximize the profit. This way, we will not be unnecessarily booking loss. And also, we will be able to identify the type of moves the players make it, and then we are very sure that the players cannot continuously drop the market or continuously rise the market. They have to make up and down moves in the market. Only then they will be able to get, okay, our order is filled. Okay, so that we will be able to really understand that they are able to make definite moves in the market. So now you find our order 1.3382 is filled, so it becomes by position. Because this sort of tricks, they are bound to do it in the market. So if you are in a hurry and try to take the position in the market, then once they make a small dip of 10 pips, we become jittery. And there are scalpers, and if they make a small dip like this, immediately they cut the position. But we have the hedge order to limit the risk. And if it is hedged, we will review it for 10 to 30 minutes. The hedging is not making profit. Okay, they just made a downward extended move because already they are holding it below that of the initial low for more than 30 minutes. Now it is 8:33, more than 30 minutes. So they are doing an extended move for 2 hours. After 2 hours, you will find silently Euro started gaining it. And during the second part of the webinar, I will show you in the same live market code page how we are able to differentiate the stop and from that of the extended move from that of the intentional move. Now our GPP position is also filled. And yen has not been filled, and we will take Australian dollar. So we have to mention that. Australian dollar, and they just cut the low and they just come back quickly. So we'll try to take the market position. $0.9332, and our so we have kept 30 pips below the hedge order in the case of Australian dollar also. See? That was a false move in the case of euro. They came exactly to this 83.80 and reversed. And in the case of GBP, they cut it by about 1 pip and reversed. On the Australian dollar, they just made a small gain in the dip, and they are likely to gain upward here. And always keep it in mind that when you are just looking into that of the negative net changes or positive net changes, when they go up to that of 75 pips negative net change or up to that of 75 pips positive net change, they can reverse in a given day. Reverse the market in a given day. That means if they are dropped up to 75 pips net change, and they can reverse and get back all the losses and go to the other positive territory. But if they drop more than 75 pips, it is unlikely to reverse on the same day. And definitely they will reverse it on the next day, because after the intentional move, they have to do the extended move the next day. So that you have to keep it in mind. So these are all the positions. So you can just make a note of it. I will just narrate here the remarks, how exactly the market moved afterwards, and also how I handle the positions, and show it when you come back by 13 GMT. So I'll present tracking the forex market together part 2 between 13 and 13:45 GMT, and explain to you the outcome of the results or the trades what I have taken, and also review that during that of the late European session, what happened to that of the initial high, initial low, the net change in all the majors and commodity pairs. So if you've got any questions, you can ask me the questions, then I'm willing to answer to those questions. Meanwhile, we will watch the live market put page here if anything drastic happens. So do you like to have information pertaining to that of any specific concepts what I explained? You can ask me. Okay. Yami has got a question. What about Indian rupee? As per your expectations, it was supposed to strengthen below 60, but it has started weakening. This is nothing but the month beginning weakening move, and they are expected to strengthen Indian rupee from coming days. Yesterday it was a false move, week beginning false move. And, because of the reactions of the international market, they just made the moves yesterday. And also today, they just nominally gained in order to make a drop. And later on, as the weeks proceed, you will be able to understand how INR becomes stronger. Any other questions, please? The players have to earn. That is why they are doing it. Now, in the case of Euro, they cut the new low by 1 pip in damage. How do we know approximately what time the crosses begin to move, and are there any relations to that of the majors? Because of the moves in the case of majors, the crosses makes the move, not otherwise. So the players mainly focus on 2 majors at a given time. When they make the moves in those majors, then automatically the corresponding crosses move. So for example, they make the contrary move. Sometimes yesterday you would have noticed that Euro was in positive net change and GBP was in negative net change. As a result, Euro GBP was gaining quite a bit yesterday. And from that of 0.83, they gained it up to 0.84 level. Now they are simply holding it at a higher level in order to sell. At the time when the market is not dropping, immediately those who had taken the sell position yesterday in a hurry around 83.30, they will think that, okay, it could go further high because Euro does not appear to be dropping and GBP is making a free fall. Immediately they will try to cover their short, and later on they see that the players use some trigger market news and quickly gain the levels in the case of GBP more when compared to that of Euro. They cut the new low also in the case of GBP. As I explained, that it is going to be an extended move for 2 hours. So if it is an extended move for 2 hours, normally we wait for about 1.5 hours and try to take the position. But since I have to wind up the webinar in another 5 minutes, I take the position because wherever you take the position, still, if you have the hedging order, you can continue to trade. Then we will be able to master the art of trading. Irrespective of the market condition, we should be able to take positions and try to earn money from there. Because ultimately it is a man-made market. So we should not become afraid. And Ramesh, how do we know? Okay. The crosses begin to move only during that of the mid-sessions. And as I given in the session timings, okay, the mid-sessions, they primarily handle the crosses, and you have to see the net change in the case of crosses. And suppose Euro is making a negative net change and Yen is making a positive net change, you hardly come across any impact with regard to that of the Euro Yen. So wherever you come across a contrarian move, only then you find big moves happening in the case of crosses. At the time, if you try to commit positions in crosses, you'll be able to make 100 to 150 pips profit. Otherwise, you will be happy with only 10 to 15 pips profit. Now, if you watch, they are coming to the mid-session. They made the drop in the case of Euro, made the drop in the case of GBP, made the drop in the case of USD-Yen. This is mainly to make a dip in the case of Euro-Yen. So our position 67, now it got filled. So now you can understand the importance of patience while trading. Any other questions? Richard, what would be your view on GBP likely to go down? See, they already made the drop in the case of GBP, and as you know that GBP is the currency which is used to create the market sentiment, and they made the drop in the case of GBP. It is unlikely to drop very big. They are carefully making a dip and trying to buy. Always keep in mind the players drop the market and buy. But actually it is not bearish according to them. They forcibly drop by circular trades, and when the market drops, immediately the traders look into the chart and say that, okay, the support turned resistance, so better sell. Then they try to sell position and quickly book 20-30 pips profit. Then again, another support is broken, then they sell 10 lots so that they'll be able to get 20 pips and they'll be happy with that. Then they breach another support and goes down. At that time, they take about 20 lots, sell, and see that they are totally trapped, and the market reverses in a very big way upward and say that because of fundamental, the market has gone up. Technically, the market has breached the supports, but fundamentally, the market has gone up because of the data, and the last 20 lots without any stop will eat away all the 10-15 pips profit what they earned in scalping, and lose the equity if they fail to keep stop at entry or fail to keep appropriate stop. So this is what the players know very well, the weakness of the traders. When the going is good, the traders commit more, and also the traders have got the tendency to do the averaging when the market drops without understanding where they have to do the averaging. You can do the averaging trade without a stop, provided you do the averaging every 150 pips drop. Then without a stop, you can trade even with a limited equity and see that you don't take exposure for more than 10% of your equity. Without a stop, you will be able to still earn money. But if you simply take the average every 20 pips, 30 pips drop, then when the market drops another 100 pips, your account attracts margin call. So understand that all the mistakes are committed by us, not by the market. And there is no point in telling that market is crazy, because the players are here to make the market appear it is following technicals and fundamentals, and later on induce induce you to say that the market is really crazy. But ultimately, they earn the money and we emotionally lose the money. And what is responsible here is our emotional status. So once you become emotional, we fail to understand the common sense. And once you fail to understand the common sense, because that is supposed to be there for everybody, when a particular thing is available cheap, we intend to buy. When it becomes expensive, we don't buy. But in the market, in the name of technicals, once euro gains to 1.38, we aim that it could go to 1.41 and buy it at 1.38. But once it comes to 1.33, we think that 1.32 is the support, so let us sell. So this is illogical. But technically it might be correct. But instead you can avoid the sell and wait for them to come to 1.32 and take a buy, then you become a sensible trader. And invariably what happens, the traders wants to grab the money in every move of the market. That is next to impossible because we cannot watch the market 24 hours all the 5 days in a week. So we have to understand our limitations. Whenever we are available for trading, we can watch it carefully and try to take the positions, limit the risk, and maximize the profit. We'll be able to easily earn from the market. Some more questions? Okay, Richard, what is your view on that I explained? The winner effects. How big is the euro drop from initial low expected? Okay, now what they have done it, initial low is 1.3390. They dropped it up to 1.3372. So extended stop and normally for about 25 to 35 pips, and afterwards they just reverse the market. They already done it in the case of GBP. Euro, they are just trying to induce the traders to take long and just create the fear by making small dips, and they are accumulating the positions. And if we trade with a hedge order, we will not be afraid whatever way they try to make the move. And if we are hedged, we will watch the hedge for 30 minutes. And if it is not making profit, we'll close the hedge and keep another hedge order 30 pips below. And once the market started going up, we'll move it to the same level, 1.3352, until the market goes above 1.3382. See, in the market, we need to understand one thing, that the market is not linear. They don't make a straight rise or a straight drop. They have to make the swings. And we need to understand what is the meaning of that particular swing. So that is why there is no point in simply calling it as a swing. Instead, we have to call it as type of moves. And these type of moves, once you know that it is an extended move, you would have noticed that how exactly they come together 1.3390, the initial high, and started making a dip. So they are not gone above and stayed there for 30 minutes to confirm it. It is only a stop point. So we can easily identify. They do it in a very systematic way because they are sitting all over the world and operating the market. So they cannot have different rules for different centers. And Ramesh, with regard to the hedging your order, do you apply this mindset for session? For session Asian, European, New York, or does it change because volatility is different? No, always it is 30 pips and not a variable hedge order. And it's just 30 pips because we cannot afford to take more than 30 pips, the risk at a given time. Why 30 pips? Because normally in a stop and they do it for 15 to 23 pips. And the platform providers could do another 2-3 pips downward or the upward stop ins. So keeping into consideration around 25 to 27 pips, we keep 30 pips hedge order. If it is hedged, then definitely we'll have time to watch it. And there won't be any hedge and hit and run show. And definitely we'll be able to see. We can close the hedging with stop at entry. And in the event if the hedging is making profit, we keep stop at entry. Let the market come down anyway. And later on when they start rising it, we'll be able to close the hedging with stop at entry and continue to trade with a buy position. Otherwise, if they drop consistently and stop forming the new low, and we know that it should be an intentional move, because if it is more than 2 hours, they are continuously below that of the initial low, it is intentional move. We wait for 2 sessions and the start of the third session. And the third session, so now they have started breaching the low from that of the European. So US session and start of the Japanese session. And if they make further downward move, we'll try to just close the hedge order with a profit and keep 30 pips below the hedge order. And they will start pricing it for tomorrow. So it is intentional, alternate with extended. Always keep it in mind. That is how they do it. And it is not the first time I am seeing it. For the past 18 years, I have been seeing it. And if you start watching it, you'll be able to really understand and appreciate it. Okay. Drew Sangvi, our prices on the live market could be refreshed every minute. No, it is not refreshed every minute, sir. And it is slightly delayed. And I have got another code page, but I cannot publicly share, which is updated every second. Because all the code page providers, they try to play tricks. And here again, no, when I was using it with the GMT time, they just changed it to that of the US time. So that's part of the game, because they do not want you to earn money. Then more than 2 hours, market is below low, then how buy in euro? Yeah, if it is more than, see, I had to complete the webinar in 45 minutes, so I had taken the position. Still, I'll be able to handle the position if it is hedged also. That is why I taken the position. Otherwise, if it is in extended move, we wait for 1.5 hours. On the last 30 minutes, that is from 8 to 9:30 GMT, we'll wait. And between 9:30 and 10, we'll try to take near the new low. When the new low is not breached for 30 minutes, we'll try to take a buy position. It is fine-tuning of our input. In FX trend, what is your opinion on the movement of the price between big numbers ending 0, 0? See, these are all nothing but the psychological numbers. So ultimately, any number we will be able to give an attribute. A Fibonacci number or a random number, or you can just say prime numbers. All these things, they are all nothing but our own attributes to those numbers. And whenever you come across the round number is happening in the market, immediately we just say that it is a psychological number. But if you honestly speaking, how many of such psychological numbers are really creating panic to the traders? It is on certain occasions it happens, not every time. But still, for our market commentary convenience, we try to use it as a psychological number or a Fibonacci retracement number and things like that. But according to my observations, if we notice the lows and the highs, what they are set for a season, always it will be a prime number. Okay, now I will not take more time, so I'll come back by 13 GMT and show you the fate of the trades, what I just initiated. And if I'm able to book profit, then you see that consistently it happens in every tracking the forex market together with, then probably you can just use it as a type of trade for your trading method and try to improvise on it using your common sense. So try to track the market between 8:45 and 13 GMT. I'll come back on 13 GMT and just to give you yet another session of tracking the forex market together. Thank you one and all. See you by 13 GMT. Hope the trades are in profit by the time.